Q1 earnings season continues, and I'm really sorry for being late on this update, guys. I got just a little busy recently setting up the channel's Discord and Patreon and other stuff, which, by the way, thank you so much for already showing me a lot of support on there, guys. It means so much to me. Thank you. And I've been having a lot of fun chatting with some of you on Discord and stuff. It's been awesome. But with that said, in today's video, I'm going to give you guys a quick rundown of some of the biggest tech giants that reported this past week, including Microsoft, Amazon, Google, and Meta. And I'll let you know how they did in terms of their earnings report, how the stock market is reacting to them, and whether I think these stocks are a buy post earnings and considering them for the long term. So I hope you guys are excited for this video update, but let's not waste any time. Let's just go ahead and jump straight into it. Okay, now Microsoft and Google were the first to report last week, so let's start there, and then we'll cover Meta and Amazon right after. But Microsoft was first to report, and guys, Microsoft, it just continues to be a beast. They are just an incredible company, and I'm so glad that over the many years of investing, I've chosen to hold it as one of my biggest investments, which in recent years, it's actually been my #1 largest holding in my entire portfolio. But they came out and posted almost a double-digit beat on EPS and 3.5% beat on revenue as well. And mind you, analysts usually estimate huge numbers for Microsoft because they're consistently strong. They're one of the strongest performers in the world and very consistent at it. And so, I mean, just look at this right here. Despite their already gigantic size, they still grew sales by over 7% year over year at a time when the economy might even be in recession. And just like always, unbelievable efficiency and profitability, growing their net income and EPS by about 10% year over year. That's just incredible. I feel like they're in a league of their own. But there's several reasons why Microsoft is dominating. I mean, just look at cloud. While Amazon continues to have the most market share, Microsoft has been steadily closing the gap every single year. And mind you, they're still growing at a high rate despite the economy causing the cloud market to slow way down. In fact, the overall cloud market slowed from 36% growth last year to just 21% this year. Now, that's obviously still very high growth, but again, Amazon isn't really growing their market share at all, while Microsoft continues to gain. And really, the only thing kind of holding Microsoft back at this point is that really weak macroeconomy. In fact, you can see very clearly in their products and segments that the only real thing that they've been in very heavy decline recently has been that Windows OEM segment that's falling by 30 to 40% in each of the last 2 quarters. That's a huge drop, guys. And that's because people are just not buying new computers, and that's hurting their Windows licensing sales. It's also because we're coming off of the pandemic and less people are stuck at home glued to their computer. However, I would really consider these only to be temporary issues. And when you look out into the future, Microsoft still has some huge growth levers to pull on. One giant example of this is, of course, their recent heavy investments into ChatGPT that seems to already be paying off for them after integrating it into their Bing search engine. For the longest time, Bing has been really a complete joke when compared to Google search, but after the integration of ChatGPT, Bing has now hit over 100 million monthly active users, which I believe is a new record, or at least it's got to be one of the highest levels that they've ever seen. But granted, Google is still miles ahead of them at well over 90% of the market. There's no, denying that. But if Microsoft can capture even just a small piece of that market, you're still talking about billions of dollars that are really up for grabs. Another issue for Microsoft, though, is that their acquisition of gaming giant Activision Blizzard has now been officially blocked by the UK. Now, Microsoft was hoping to add Activision's library of games to their Netflix-like streaming service called Xbox Game Pass. That was, said to be the next like Netflix of gaming. It was going to be a huge deal for them, really bolster up their gaming inventory and library. But UK regulators fear that Microsoft will make those games exclusive to the platform, thus hurting competitors. So they went ahead and blocked it. But in my opinion, I would say that the block is kind of ridiculous. I mean, Microsoft has already offered to keep the most popular games on other platforms for more than 10 years after the deal. So what are they so afraid of? And Vice Chair and President Brad Smith commented on the block, saying that they are still fully committed to the acquisition and will appeal the CMA's decision. Activision also chimed in during an early release of their earnings report because they released it early because of that block. And they said that the CMA's decision is irrational and inconsistent with the evidence, which I fully agree with myself. Still, Activision stock has now fallen by almost 13% in the past week following the announcement. Now, right now, Activision trades for less than $76 a share, which is even lower than the $105 that it used to trade for before the acquisition was even announced. And it's also significantly lower than the $95 that Microsoft is willing to pay for it. Might be a good speculative play at this point. I own a couple shares myself just in case, but you'll definitely still want to be careful with this one. Obviously, Microsoft is going to be the safer long-term stock to be betting on if you're going to be investing in one. Not only rallying over 10% this past week, but Microsoft is also up over 200% in the past 5 years with incredibly strong financials year after year. The only issue is the valuation is a bit rich at a PEG ratio above 2. So as already my largest stock, I'm not really buying anymore at this time. But for anyone not in the stock, I'm not really sure what you're kind of waiting for or why you've never entered it. It's one of the strongest companies in the world, guys. I think it's a great stock to be holding. Moving on to the second stock, Google. They also did very well on their earnings, beating on both the top and bottom line, with also an EPS beat of almost 10%, very similar to Microsoft. However, unlike Microsoft, Google's search business is struggling during this weak macroeconomy where businesses are less willing to spend money on digital advertising. As such, Google's search and other segment only grew by less than 2% in the quarter, which is down dramatically from the nearly 25% growth they saw the year prior and over 30% growth that they saw the year before that. In the investors call, Google management talked about the economy being very rough right now, which is why their outlook remains uncertain, with both YouTube ad revenue and overall ad revenue both falling in the quarter. And I would also add that one of the reasons why their search is kind of struggling a bit too is probably because of the increased competition from Microsoft. Now, this left their total sales only climbing by about 3%. That's one of the lowest growth rates that we've ever seen in the history of the company, and you can see that on this chart here. As a result, Google has announced the largest layoffs in their history, cutting 12,000 employees, or about 6% of their workforce. Still, despite the challenges, Google has actually decided to buy back their own stock, announcing a staggering $70 billion stock buyback program. And I gotta say, guys, as much as I hate to see the layoffs, the stock buyback does actually make sense to me because, I mean, to be honest, I've been buying the stock myself very heavily over the past year. So obviously, I'm going to have to agree with management here to be doing the same and be buying the stock. I think it's cheap. Now, yes, this year is rough with sales only expected to grow by less than 6%, but the following year it's expected to rebound back up to double-digit growth despite their already massive size, doing over $300 billion in sales. And while ChatGPT is a growing threat in search, I think Google's investments in AI will slowly back being off, and over the long term, I expect them to still remain mostly dominant in search. I don't think it's as big, maybe as big of a deal as people are making it out to be. And while the stock was mostly flat this past week, and even though it's up almost 20% year to date, we're still seeing one of the largest dips in the stock's entire history, still down over 30% from the top, and leaving their valuation almost 25% cheaper than the sector on a PEG ratio basis. I'm sorry, but as long as Google trades cheaper than the sector, in my opinion, it's a long-term buy and a pretty solid one. All right, now after Microsoft and Google reported, we had Meta report the next day, and this was a huge improvement from prior quarters where they had consistently missed on the bottom line, with each of the previous 2 quarters in particular seeing over 11% and 21% misses respectively. That's huge, guys. Now this quarter, however, they actually destroyed analyst estimates, not only with a small beat on revenue, but a giant beat on EPS of over 30%. And while sales only slightly grew by 3% year over year, it was actually the first quarter of growth for them in nearly a year. So a welcome, like a huge welcome sign to investors that, hope is not yet lost. Now, this was largely boosted by their investments into artificial intelligence, which they mentioned in the earnings reports that it helped their TikTok clone Reels increase its monetization efficiency by over 30% on Instagram, while Facebook also improved by over 40% from the previous quarter. Daily revenue from their Advantage Plus advertising platform also multiplied by 7 times over the last 6 months. That's big. On the negative side of things, though, their investments into the metaverse continue to be a major drag on their profits. And that's no surprise. They lost another $4 billion this quarter, and that's after losing another $14 billion on it last year. And it's also resulting in a huge number of layoffs at over 20,000 in total. However, I continue to say, guys, Meta is an already very large company that needs to put their money to work in some way. I mean, they got to invest in something, so why not invest in whatever they can that is at least somewhat innovative for the future? And in my opinion, they're the best position to benefit from the metaverse, which, if that turns out to be even just a fraction of the size that analysts are predicting, it could be a giant growth driver for the company. McKinsey, for example, estimates the metaverse will be worth $5 trillion by 2030, while Citigroup estimates as much as $13 trillion. And last year, there was over $120 billion invested into the metaverse by corporations, which is almost 10 times the amount that was spent the year prior. So clearly, this is something that people expect to be very large in the future. Well, Meta already has close to 80% of all internet users on at least one of their platforms, and even with that already gigantic size, they still managed to grow users by another 5% last quarter, now reaching a mind-blowing 3.8 billion people. So that's a huge amount of people that they can try to get over to transition over to the metaverse. Or they could just simply implement the metaverse into their already existing platforms. I mean, there's a lot of different ways that they could play this out. But meanwhile, Meta is already doing over $40 billion more in sales than they did before the pandemic, and they're also still expected to grow by nearly a double-digit rate per year. And yet, despite the stock surging over 15% this week and sitting almost 100% higher this year, it's actually still down close to half its value from the top and trading over 30% cheaper than the sector. So, in my opinion, I still think that it's a long-term buy. I mean, I'm still liking it. All right, finally, we had Amazon report, who arguably had the best results of all, if you can believe it, completely destroying analyst estimates, not only posting a small beat on revenue, but over a 42% beat on EPS, which is pretty damn impressive. That's the highest of all the tech giants that we've covered today. And yet the stock is actually down close to 4% for the week. And while it is up over 20% this year, it's still down close to half its value from the top in one of the biggest crashes that we've ever seen in the stock. But overall, Amazon is a little bit of a mixed bag right now, mostly because of their super crucial cloud business that is slowing down pretty dramatically, down to just 16% growth versus the 20% they saw the previous quarter. What's even more concerning, though, is that April numbers are already in, and finance chief Brian Olsavsky has warned us that it's even lower growth at just 11%. So it continues to get smaller. And that's because, at least the growth does, and that's because of tough economic conditions where companies are trimming their spend on cloud services. And of course, you can see that in this chart here that I showed you earlier, where AWS is pretty much flat, while Microsoft and Google continue to close the gap as the second and third largest providers. And because Amazon relies on AWS so much for profits, they're now having to lay off tens of thousands of employees in what has been their largest cuts in history in order to cut costs and sustain some level of profitability. Still, I continue to say that investors just don't really realize how badly they're misjudging Amazon. First of all, they had expanded too much during the pandemic to begin with, so cuts were needed to be made coming out of it. Secondly, even with the pandemic growth fading away, they're still putting up some really impressive numbers, especially on their online shopping and digital advertising businesses, which are very, very large and very important. And these were the main reasons why they beat analyst estimates by so much. In fact, digital advertising grew by 23% this quarter at a time when the market is struggling. And now Amazon is already the third largest in the world, only behind Google and Meta. And take a look at this chart here for their segments. AWS went from 37% growth last year to just 16% this quarter, but advertising services is still above 20% growth, while third-party seller and subscription services, which makes up the bulk of their e-commerce, all accelerated by huge amounts to around 20% growth or more. And they're also doing a great job of cutting costs and making their e-commerce segment more profitable over time, with cost growth slowing way down year over year, while North American operating income profits finally actually turned positive. And that's a huge deal, guys. We hadn't seen that before. And even with the cloud struggles, you're talking about a company here that does over $500 billion in sales and is still doing around a double-digit percentage in terms of growth on those sales. So that's like mind-blowing. Now, sure, the profits are very small right now, which is why the stock trades over 50% more expensive than the sector on a PEG ratio. But guys, Amazon isn't even really trying to be profitable. That's what everyone forgets about Amazon. They're not trying to make profits. They're trying to dominate the world, and they're doing a pretty good job of that. Over time, though, the profits will come. And when Amazon decides to finally flip that profitability switch and focus on their margins and really benefit from the economies of scale from all the expansion that they've done, well, then I think you're going to realize that the stock being down like half its value is actually a pretty good deal if you're thinking about it long term. At least that's my opinion. I still think that the stock is a buy. I own all 4 of these stocks that we talked about in today's video. I'm bullish on all of them long term, and I continue to invest in them and hold them. So I'd love to hear your thoughts though. Do you like these stocks? Are you invested in any of them? Or are you more bearish? I'd love to hear your opinion on it, and I'll try to respond to as many comments as I can down there. But thank you so much for all the support, everyone. I hope you're all doing well. I will catch you in the next video, my friends. Take care, everybody. Bye-bye.